Good afternoon, everybody, and welcome to this session of the 2022 Higher Education Climate Leadership Summit. My name is George Dyer. I'm the Executive Director of the Intentional Endowments Network, and I'm joining today from Gloucester, Massachusetts, which is the ancestral lands of the Agawam and Pawtucket people. For those of you who have not been in previous sessions or our opening session, we are sharing land acknowledgements at the beginning of each session to keep this issue front of mind in our work and how it integrates into our work in advancing sustainability in higher education. We're very excited for this session today, a keynote on integrating sustainable investing options into retirement plans. We have a fantastic lineup of experts and professionals talking about some of the key factors, barriers, and opportunities around this, and particularly a new rule from the Department of Labor that we'll hear a lot more about. For those of you at colleges and universities, we encourage you to be in touch. We have a whole initiative around sustainable retirements at the Intentional Endowments Network, supporting advancing these conversations at your institution, and we'll share a little bit more about some upcoming plans on that at the end of the session. So please do be in touch and enjoy the session. With that, I'm going to hand it over to our moderator, David Feingold, President of Chatham University. David.
Thanks so much, George, and it's a pleasure to be with everyone today. I join you today from Pittsburgh, Pennsylvania, the ancestral home of the Shawnee people, and I'm really honored to be able to chair this session. As George has said, this is addressing a really important topic, a topic that impacts over $1 trillion that all of the employees of the 4,500 colleges and universities in the U.S. have invested in their retirement savings. And as we'll hear, there's a really exciting change in the works from the Department of Labor, and we have a great panel to discuss this. For those of you who were on yesterday, you may have heard the new research from Schroders, which did a retirement survey, and it really pointed to just how vital the discussion we're about to have is. It said that 9 of 10 of those surveyed would like a sustainable investment option and would consider it if it was available. And I thought really striking, 69% said that they might consider putting more money into their retirement account if it was available. And we know one of the crises we face in the US today is far, far too many Americans don't have enough in retirement savings. So if this can be both a win for the environment and help address that issue, that would truly be a win-win. I think we have an ideal panel to discuss this today. We have Ali Kawar, who is the acting assistant secretary at the U.S. Department of Labor in the Employee Benefits Security Administration, overseeing a team of 20 people who are all working on the new rules for retirement plans and including ESG, which he will share with you. We have Tiffany McGee, who is the Chief Executive Officer and Chief Investment Officer for Pivotal Advisor, who is one of the members of the steering group for the IEN Sustainable Retirement, who is the global head of responsible investing for Nuveen, which is part of TIAA, the largest single manager of retirements for higher education. And so we have really expert panel today to guide us through this discussion, and we really hope it will be interactive. So please be ready with your questions. Ali, I'd love to start with you. This is one of the most exciting developments in this space. Could you share for the listeners a little bit of the history of the department's involvement with rulemaking for ESG, and then in particular, how the Biden administration is setting about addressing this?
Yeah, thanks. Thank you for the invitation. And so I'm in Washington, D.C., which I believe is Anacostan land, if I remember correctly. But so the Department of Labor has been involved in these issues for a number of decades, actually. And the question of ESG first came up in a slightly different context, which is actually in the context of labor unions, which asked the department, if they were considering investing in a project that would benefit the labor union, but was also financially the best project, was that a problem? The kind of additional benefit that might be thrown off that would benefit the union. To what extent did that, require them to ignore that project altogether? And over the decades, our answer has been very consistent. on this issue, which is that the obligation of the plan fiduciaries, the people that are responsible for making these decisions, is first and foremost to that financial bottom line. And so if there are other things that are kind of get thrown off, that's okay. Those collateral benefits are okay. As long as when you're making that decision, the question that you're asking and the question that you're answering is, what is the financially best option available to me? Over the years, I don't want to pretend that we've been a monolith on this, because it's actually been quite the opposite. And what you've found, I'm not saying this as a political statement, but in reality, in different administrations, the department's approach has been fairly significantly different. Starting in the Clinton administration, the department undertook an effort to kind of collate all of the guidance that had been issued that was a little bit more informal and kind of restate it all in one place in 1994. That proved to be quite controversial. And in the Bush administration, there was an effort to restate that, which was then revisited by the Obama administration, which was revisited by the Trump administration, and is now being revisited by the Biden administration. That core message that the fiduciary's obligations are primarily and kind of exclusively to the financial benefit of the participants and beneficiaries, that has never changed. But what has changed significantly is in different administrations, you've seen more permissive or more discouraging language surrounding that, because that statement is very simple, but when we talk about this, there's a lot of other stuff that goes into it. And in particular, in the last administration, there was a rule that was issued, which is still on the books right now, that was quite negative. We did a fair amount of engagement, and we consistently heard that it was counterproductive because it was so negative that people thought that even when they had an investment they were looking at that was financially better, this rule was pushing them to not exclude it, to not consider it and not take it into account. So that's the first part of your question, kind of the quick and dirty history of our efforts on this. In terms of the Biden administration's approach, this is a very high priority for us. So on day one of the administration, January 20th of last year, the president signed an executive order calling for different parts of the executive branch to look at different rules and make determinations about whether they needed to be revisited. This issue is one of the rules that in our case, the Department of Labor was asked to look at. And there's a subsequent executive order that was issued in May of last year that focused on climate-related financial risk in particular, more than kind of just the broad ESG strokes. The focus overall of the executive order was on ESG, was on climate. And that order, again, asked us to look at what had been done and a couple of other things that we might get to later. Following on from that, we issued a proposal last year. And I'll maybe sum up the proposal in just a couple of sentences. Essentially, our view, again, coming out of a pretty significant amount of stakeholder outreach and conversation with some of my co-panelists and a number of others, really led us to conclude that, yes, the sense that we had gotten of what the impact of the Trump administration rule and the perception was widespread. Whether you're talking to labor unions, consumer advocates, Wall Street firms, you run the gamut. Everyone said very consistent things, that they weren't really being allowed to operate with the flexibility that our statute, ERISA, is designed to afford to investment advice fiduciaries. And they gave us stories that, you don't really expect as a regulator to hear people telling you that they're making subpar decisions because of rules, but that is essentially what we heard. So what we did in our proposal, and again, it's just a proposal, the comment period's closed, we're thinking about what that final rule will look like, is to kind of get us out of the middle, to instead set up a framework that puts the fiduciary themselves in the driver's seat and says, look, there are going to be times when an ESG factor or any other factor is financially material. It is part of that analysis. You're trying to figure out what is the best, lowest risk, highest return option that's in front of you. How can you make sure that that's the thing that you're pursuing? sometimes that's going to mean taking into account ESG as part of that analysis, because, if you're thinking about digging wells in a place that's going to experience a drought because of climate change is a really material part of that analysis as you're thinking about what the long-term return of that particular kind of project would be. And at other times, maybe less so. So we didn't really go as far as to say, you have to take into account ESG every time. But there's been a change in the marketplace as the department's kind of been pronouncing, in favor or disfavor. There's been a change in the marketplace over the years that really this is designed to also capture, where there are more circumstances now where you can point to a particular factor in a particular context and say, no, this is material. I want to take it into account. And the fundamental premise of our approach is to say, yes, when it's material, take it into account. If it's not, that's fine. There are other ways for some investors are very interested in this. And one of the other things we proposed is a mechanism where it may not be as financially material to that core consideration, but there are other ways that you can take it into account. And we laid that out in the proposal as well.
Great. And just a couple of things to clarify on this. First, do you have a timeline? You mentioned the comment period is closed. Do we have a sense of when the new rules might be issued?
Sorry, I'm not sure if it was just me. Your audio was pretty garbled for me. Could you say that again? I couldn't quite make out what you were saying.
Yes, I was just asking if you had a timeline for the issuance of the new rules. Can others hear me okay?
Okay. Someone put it in the chat. Perfect. Hopefully you can hear me okay, and it's just something with the incoming audio. So our timeline for the issuance of the new rules, I can tell you that this is a very high priority for us. That team of 20 is maybe not giant in the context of our agency, which is, in the 800s. But for a project like this, it is a significant resource allocation. I'm happy to say that we got a lot of very helpful and robust feedback. But the flip side is that then it takes a bit longer to go through everything and figure out what the right course of action is. But we're actively working on it. We do want to get it out as soon as possible. And in part, one of the things that we recognize isn't just that this is an important issue, but we did hear very convincingly and clearly from our regulated community about the impact of the final rules that are currently on the books. And so even though we've issued a non-enforcement policy, even though we've issued a proposal, the work isn't really done, at least this stage of the work isn't really done until that final rule comes out. So we are trying to get it out as soon as possible.
The other question was just around the default option and whether or not that could be included in the final.
Yeah. And I'm happy to say your audio is coming through loud and clear now, at least for me. I think I may be the only person that was experiencing this issue, but that's a separate thing. So, I talked a little bit about the rules that were put out in the last administration and the chilling effect that they were having. One way in which they were viewed as kind of putting a finger on the scale is on this issue of QDIAs. And so for those of you that aren't familiar, QDIA is Qualified Default Investment Alternative. Essentially is a rule that we put out 15 years ago, maybe, that deals with situations. The primary situation it was designed to deal with is when you have someone that's automatically enrolled, but you need to figure out what to put them in. And QDIAs were primarily a mechanism to deal with that. They've obviously become very popular. See the explosion of target date funds, which are a very popular form of QDIA. And what they did in the last administration is really question whether there were any circumstances ever where you could have an ESG-focused QDIA as that default investment alternative, whether it was ever really appropriate to have that. So what we've said in the proposal is that, yes, we do believe that you could take it into account. We do believe that ESG can be material. We think there are any number of ways in which a fiduciary might conclude that having an ESG themed QDIA might be appropriate. The way the proposal works is we said, essentially, if you meet your fiduciary obligations and you conclude it's the right thing, then, go forth and QDIA, if you will. But if you're making decisions, and this is kind of across the board, if you're making decisions, I mentioned this concept of there's another way to get there if you conclude that primary risk and return isn't going to get you there, but you're really interested in this. That concept is essentially something that we call a tiebreaker. It's a concept that, again, is laid out in the proposal, where what we say is if you are then choosing between essentially equivalent options, and you need to decide you're not going to be able to invest in all of them, and you're making the decision about what to invest in that circumstance, it's fine, even if it's not financially material, to use an ESG factor. And in fact, it doesn't have to be ESG. It could be something else, because one of the other things that I would observe that we're trying to make sure as part of this effort is there has been this notion that there's investing on the one hand and ESG investing on the other. And part of that change that's happened in the market that I was referring to is that those two things aren't these separate universes anymore. They are intertwined. ESG investing is investing, and investing can be ESG investing. And one of the things we're trying to make sure is that there's no longer this kind of othering and kind of scarlet letter approach to ESG. It's the same as any other risk and return factor. You should take it into account when it's material. You don't have to when it's not. And in the QDA context, that concept is what we've laid out as well.
And for those who don't spend each of their days thinking about this investing and the rules, I know I was struck in preparing for the panel. I believe that up to 80% of all of the funds invested may go into that default option within the retirement fund. So just this one part of the rules could have a huge impact, right, in terms of the overall invested funds.
Yes, there's been a lot of work over the years to try and figure out how we can get more people to save for retirement. And a consequence of that is a lot of things that, the retirement nerds will talk about, like automatic enrollment, right? You join a company, you join an organization, and automatically you're enrolled in the 401k at a 3, 4, 5% level. And again, the QDIA concept is, what do you put people in? And because of inertia, a lot of people not just start there, but they stay there over the course of their tenure with that organization. And so, yeah, the QDIA part is quite powerful. I mean, I think there's data to support this, but I will tell you my belief: target date funds as a thing would not really exist on the scope and scale that they did without the QDIA rule. It really is kind of marked how much the asset growth has been in target date funds post that rule. So it is quite significant.
Great. Well, I think, Ali, your prior comment about how ESG and investing are evolving leads really well, Tiffany, into question for you. Could you talk about, again, for those who are not in this every day, sort of how the notion of ESG itself has been evolving for investing, what we're seeing in the trends in the market, and the significance that you might see from this rule change?
Okay, thank you. Yes, I'd be happy to. So I think first, I always like to start these conversations around ESG with kind of level setting of what I will just go ahead and say, like the real definition of ESG. And I think over the years, the term ESG has really morphed into a lot of things. And when you hear people talking about it on TV or podcast or in magazines, it is around this idea of a stamped fund, right? Or stamped strategy. What I mean by that is like a low carbon emission fund, right? Or a socially conscious fund. But we really view ESG as a process, not a stamp. And that really is how a lot of the institutional investment community is starting to really view that. Some are there already now and have been for quite some time. And so really what it is looking at the responsible environmental, social, and governance metrics of a company, of a strategy, and lining them up alongside the traditional financial metrics that you would use as an investor, we're investors, to make an investment decision. And the idea is that there are some things that don't show up on a balance sheet, right? So portfolio managers, CIOs, we are doing a deep dive into companies, funds, to determine whether we want to, put our clients' money in these funds, right? So we also work with foundations and endowments, but on the retirement side, we're primarily dealing with funds. So when you think about that, and also the fact that the CFA Institute, which is, the institution that kind of, sets the tone for the investment community, they've come out and said on multiple occasions, they've even changed the CFA exam. And they've basically said, if you as a portfolio manager, as an investor, are not considering ESG factors, you're really not doing your duty. And so I think that is really, really telling. And so I always take every opportunity to kind of level set that. And when you think about how that translates into retirement plans, and I know, we were, just speaking about kind of like the DOL's evolution of this. And I feel like really the answer to kind of solving all of this is thinking, especially on a retirement plan, is again, thinking about it as a process, not a stamp. And what that means is maybe you're not looking at things at the fund level, but the manager level. And so I know Amy's going to talk a lot about this too, but most of the major asset managers have lots of information written about this, and they are actually considering these factors. So now the fund, if you do a search in Morningstar, may not say low carbon emission fund, but the management team is looking at everything to be able to make an investment decision. And I think that when you put it into that context, the consultant or the advisor who was working at the plan level with the plan sponsor really has the responsibility to, when they're doing the due diligence, and again, depending on whether you're a 321 fiduciary or a 338 fiduciary, the onus is really on the consultant, the advisor, to be doing the due diligence and asking managers how they're viewing these metrics in their regular investment process, the regular due diligence process, not in a separate ESG bucket over here.
Great. Amy, if we could turn to you, TIAA Nuveen really has a unique perspective on this retirement savings market for higher ed, given your very strong market position. Can you say, how are your clients, are they already reacting to the proposed rule change, and how are your discussions and your colleagues going with the colleges and universities across the country?
Thanks, David. I'd love to weigh in on that. I just want to mention that I'm calling in from northern New Jersey and the ancestral home of the Lenape. So I just wanted to start out the panel with that. And then I also want to mention that we need more consultants like Tiffany. And I'll get back to that in a minute. But, I want to just mention that we do applaud the DOL providing the transparency and clarity the industry is really needed and called for with the ESG rule, and particularly appreciative of you, Ali, for your willingness to meet with us and really engage and allow us to explain why we think this is critical, because making that shift from this is no longer just about a product line to, it's a more holistic, that's going to take some work. But anyway, but this is a really important development. And, as you mentioned, David, I always say TIA has had the original ESG investors from over 50 years ago, when, a lot of people think about the start of the movement, if you will, in the US being around anti-apartheid. And so I think we still have a lot of the values-based associations on campus when it comes to talking about ESG. But again, here's what better than higher ed, where folks are dedicating their lives to these topics. They're training future leaders. They're making changes at the campus level already, say on environmental issues, committing to sustainability programs on campus. And now thinking is about the endowment and retirement asset side. But the conversations, to be blunt, they still span the gamut of very active plan sponsors who have been adding options to plan menus even during the past couple of years when things were a bit uncertain there, to active promotion of those options, to plan sponsors that we talked with that are really we're still very concerned. So about what is the legal liability here, right, of adding options and the litigation risk. So I mean, it really does span the gamut, but we do see this as a really incredible opportunity to re-engage in some places. We know there's just so many new champions, and the IEN network has played a really critical role here in advancing this conversation. And so we think that will be, we'll take conversations to the next level. But that last point, I wanted to make is, ESG is no longer just for ESG funds. I think we're going to have to focus very carefully on providing some guidance and maybe a call to action across the industry, but particularly around an issue like climate, where we can make the case. I mean, one of the biggest things that I think we did last year at TIA was to establish a net zero carbon commitment for the TIA general account. So this is the flagship fund, that core annuity that provides lifetime income for our plan participants. And so, we worked with our boards and developed investment beliefs around climate. And now we're working very hard to implement that. But really, it was an investment case that we made in that situation. So I think we need opportunities like that to show how ESG truly is embedded, and why that's in the retirement, the lifetime income need, and what's the connection there.
Amy, just to clarify on that last point you made, because obviously that annuity is a core part of so many of our employees' portfolios. Are you saying, has TIA set a target date to get to net zero, or just so?
Yeah, net zero carbon by 2050, and right. we actually we issued a climate report in December that explains some of our initial thinking on how we would implement it. But I think I mentioned that because not to be a commercial, but this is a real example of how we've committed to a meaningful ESG action, and really with a strong investment case, because we do believe in climate risk as investment risk. And we have to begin to think about what that means at the portfolio level and, develop new data sets and ways of partnering across the industry so that we all drive towards that common outcome.
Great. And I have a question for all of you, but I notice we have one in the chat. If you, Ali, you want to take that, or?
Yeah, and maybe I'll just make one other comment, building off of what Tiffany and Amy said before I get to your question.
Sure.
Tiffany, when you were giving that very thoughtful answer, it reminded me of a survey that came to my attention when we were engaged in all of that outreach and engagement prior to issuing the proposal. And I don't remember the numbers anymore, but it was kind of the majority of investors, ERISA investors, were saying, no, we don't take ESG into account at all. And it was interesting because they were thinking only of, do I have something on my lineup that's, ESG 2040 or something like that. But they didn't appreciate that whether or not their investment manager is helping them or taking that into account when they're screening and giving them options, that the fund managers themselves are doing this, and that is part of their process. And actually, the numbers are a bit misleading when you look at, because the ERISA universe does appear to be this lagging indicator of uptake on ESG. And I think there's a bit of a measurement issue there that we haven't quite figured out, because people don't know exactly what they're invested in and how much they're taking ESG into account. But on Anne's question, so ERISA does not apply to private companies. It is the law that applies to private sector employee benefits. So 401ks, defined benefit pensions, those kinds of things that are offered by a private sector organization. I will say, though, that in many contexts, the ERISA fiduciary standard is considered a very high standard. And it is used as kind of a marker and model in other contexts. And one example I'll give you of that is by its terms, ERISA explicitly does not apply to state and local government pensions, but very frequently those fiduciaries are and legislators, when they're thinking about fiduciary requirements for the state and local plans, will look to ERISA to kind of help them identify, what is appropriate or not from a fiduciary standpoint. So I will not be surprised if, once the rule is final, if we see an impact broader than just kind of the four corners of what we have regulatory jurisdiction over.
Great. So I'd love any of your perspective. So Chatham, Amy, you mentioned you have the 2050 commitment. We've committed to get to net zero by 2025. So it's coming up very quick. And that means looking at every aspect of the university, right? From our composting, our energy use, our vehicles, you name it. I'd be really interested as you think about the Second Nature and IEN members who are all here because they're committed to this goal and see the urgency on climate. How should they be thinking about this rule change and what it means for them in terms of the ability to make that and how best to communicate it, how to prioritize it? Any thoughts that you have on that? Tiffany, would you like to jump in or Amy?
I have a couple thoughts.
Sure,
I
please.
think you mentioned, so David, I think you mentioned the operational goal, right, that you have. And I just want to clarify, we're talking about the financed emissions of a $280 billion, account. But I think the point here is to make the connection, right, between, the core mission, the curriculum, right, the mission driven part, right, of your employee base to the community, sort of the campus piece, to the capital. And I see the capital as the endowment plus the retirement assets. And I think for too long, what I've seen is folks are attacking little parts of that, right, across the country. And I think it is time for more of a movement, perhaps that IEN and Second Nature can sponsor, where this is looked at in a more holistic way. And because I think it's our view at TIA that, if we see action, right, we see a campus as taking action on the endowment, there's an openness there, right, that to have a conversation around what's going on in the retirement plan and are there options. And I do think, despite our desire to make this more holistic, we'll probably have to go in on a plan menu review, and kind of into the cadence of how decision makers on campus deal with these types of issues. We're also just trying to provide more resources, and that's why I think this organization is so great at this, and really educating the champions to ask the right questions, to kind of understand the process of how reviews and decisions are made with the retirement plan. So it's still about education, but I think let's try to help our champions think more holistically about these topics, and provide a roadmap or a blueprint for that.
Yeah, I would say certainly here in Pittsburgh, and I think in a lot of the country, much of the student activism interest over the last few years has really been directed almost exclusively on the endowment piece and not on this, even though there is such a large amount of resource that's impacted by it. So couldn't agree more with the idea of thinking as broadly as we can about the impact we can have as institutions. Tiffany or Ali, anything you wanted to add there?
Sorry, I had to get myself off mute.
Sure.
I think, one thing is, from my perspective, and in full disclosure, years and years ago, I used to manage a territory for TIAA in the Mid-Atlantic region. And so I think I've seen and met with a tremendous amount of plan sponsors, more than some of my other counterparts. And I think the one thing, well, two things that really stands out is I've never met a plan sponsor that said, I don't care about this, right? And when you think about, and I think it was David, you mentioned the endowment, think about where the retirement plan is housed. It's typically not housed where the endowment is housed. It's typically housed in HR. And depending on the size of the organization, it's usually a small team. And there usually is not one person dedicated to the plan. They have other responsibilities. So I always put myself in the plan sponsor's shoes. And then when you throw in, so the one thing I always realize is, number one, they want to do a good job for participants. And number two, they also want to follow the law, right? And when you think about the 2012 regulations that went into effect from the DOL years ago, well, in 2012 went into effect, I still find plan sponsors that don't understand it, which, keeps people like me in business, but it just makes things very, very complicated. So when you add on, and now we want to make sure that we're doing our part to save the world in the retirement plan, that just complicates things even more. So I think that it can seem very challenging, and it is very challenging. So I think, as we kind of talk about implementing these things, I think it's very important. Like, resources are very important. I think, again, conversations like this are very important. And it's just I think it is a bit of a challenge logistically, from and not in reality, but logistically, it's hard for a plan sponsor or that plan sponsor's team, which, by the way, is usually maybe 2 people or 3 people, to really start embarking on this. So I think, just one thing I'll say is that we all, because all of us are involved in this conversation, we need to do a better job of providing resources.
So I'll maybe just add one thing, which is
long-term risks when it comes to investing in retirement. Uh-oh. Ali, can you hear me?
Yes, sorry, I caught the second half of that. Risks in retirement plans.
Yeah, particularly long-term climate-related risks, and maybe not even so long-term, given the latest IPCC report.
Yeah, sorry, and the question is how people can take those into account?
And particularly how the department, I know it sounds like the shift is you're putting more of that on the fiduciaries and for them to lay out the framework, but
yes,
would love any thoughts you have around that.
Apologize so much for whatever connectivity issues I'm experiencing. So I mentioned that the second executive order focused on climate-related financial risk, and I think there's a couple of things to think about. One is that executive order really kicked off kind of a really whole of government approach to addressing the particular climate-related risks, which are in some ways intertwined and in some ways unique and maybe being addressed differently. So there's things that kind of across government folks are doing. At the department, we're focused on, there's maybe 2 or 3 things I would highlight. One is the rules themselves that we talked about. And one of the things we highlight in the proposal that we issued last year is the particular challenges facing plans as investors on the climate front. But that rule is kind of ESG and in some ways broader than just ESG. It is kind of an investing rule. The second thing I would flag is the federal government also has its own retirement plan, the thrift savings plan, which is the 401k equivalent. It's the defined contribution option available to federal employees. One of the other things the executive order asked us to do is to look at how that plan, which we have some dealings with, takes climate-related financial risk into account. We've issued an RFI on that, and RFI is a request for information. We're essentially soliciting public input on whether there are things that we should be thinking about and aware of in that context. And similarly, in that RFI, we've also asked for input on whether there are other things that we can or should be doing in the context of ERISA beyond this rule, which I've been talking mostly about the investing of assets side, but it also deals with another very important issue of proxy voting and the issues around shareholder activism. What does it mean to actually hold these shares and the voting rights that you have with them? What are you doing with those? Those issues are also dealt with in here because there are a lot of parallels between the two. So there's kind of that we're doing, and the question that we're asking in a nutshell in the RFI is, okay, well, what else is there that we can or should be doing? Just going back to your last question, I mean, one of the things that I think about in this context is that I mentioned, I think, in kind of answer to your very first question, that the final rule is kind of the end of one stage. I don't view our work as complete because I think there's a lot of education that needs to happen to make people aware, not just of the rule, but also the landscape, some of the changes that have happened in the marketplace, the extent to which you can actually quantify some of these factors, the extent to which smart investors are taking them into account already. Because I think there continues to be some nervousness and some view of this as like a new thing that people don't really want to get involved in. And as I said earlier, they're not really appreciating the extent to which they're already involved in it. But also, I think there's a lot of public education and engagement that we can do, which we're planning on doing after the final rule comes out, to kind of continue along this theme.
Yeah, and just to build on that, so recently had discussions with my board. I'm guessing other presidents may have had, where we had made a significant move out of fossil fuels to try to get the portfolio to net zero for the endowment. About a month before oil and gas prices skyrocketed with the Ukraine war, and so there was an immediate reaction from some trustees. Well, see, we told you this is going to hurt our returns. And so, Amy, I'd be curious, as you're communicating with your, large range of stakeholders there, how are you thinking about this in terms of the advice you're giving to clients, and particularly thinking about the, Ali's point around how do we communicate these things effectively? Sharing some of the, really convincing research on that there doesn't have to be a trade-off between an ESG lens or a process and returns.
Yeah, I mean, particularly on the issue of climate, we've done a lot of work to make sure the conversation isn't just about fossil fuels. Certainly carbon-intensive assets are part of the overall plan, but trying to build a case around, frank, more of a risk management case that affects, many sectors, and how a diversified portfolio can approach this. So there's certainly been a lot of, internal engagement with our board, engagement with our investment teams, the risk management. And so sort of setting that the net zero carbon by 2050 has, had a ripple effect, if you will, across. And I think, we've published some lessons learned from that, some other resources that are available to the markets, for public consumption. I think the other thing is just this continued education about, Ali mentioned proxy voting, how, we're talking about, people who look at us and look at our portfolio holdings and make a judgment, right, about how are we acting on climate. And the other is the proxy vote. So another way that we've tried to further engage our constituents is by, an unprecedented level of disclosure on how we voted on the environmental and social shareholder proposals at the S&P 500. So we now maintain that. There's many climate votes. There will be many climate votes this year. And so I think using some of these case studies, particularly for maybe those who are still to be convinced, right, around like the thoughtfulness that has to go behind some of these decisions. And, maybe not every company that got a shareholder proposal deserves our vote or not, depending on the fundamental analysis there. So I think it's, we're trying to work on different types of transparency, but it does get down to, renewed focus on the needs of decision makers, and, to just, amplify Tiffany's point about, who makes the decisions around, retirement plan, menu options. I mean, that's really, we have to put ourselves into the shoes of some people who have to now look at ESG in a new way or take action, and develop, the support system there accordingly. But lastly, I'd just say, building demand is also part of our mandate here, because there's been so many surveys about this. You've mentioned a few, and that are showing about the demand. I think that's what I still hear from plan sponsors is, is there really true demand? And if we add options, will the assets flow? So we do need case studies. We need success stories, and I think the IEN platform can be a really great convergence point for that.
And Amy, beyond obviously the huge long-term impact in your core annuity, are you seeing other changes in the options, the menu of things that employees might be able to see once this goes into effect?
Yeah, I think, well, I mean, we've certainly developed options, for many different asset classes, new ways for clients to get access to these types of strategies. One thing, before we even get to an option, one thing we're focused on is just portfolio reporting and advice for clients. And again, I think the big thing for ESG is going to be, again, it's not just for ESG funds. And I think to show clients sort of ESG characteristics of a portfolio, maybe what risk that portfolio might be incurring because it's not, climate oriented, for example, and what that would take to orient that portfolio more favorably in the long term. So I think there's going to be a whole, we're working on some new tools and resources. And I think, we'll see other things like that across the market to really help clients and decision makers understand, this is a broader topic. It's not just a debate about should we own fossil fuels companies or not.
Tiffany, on one level, as someone who's come to this more from the outside, it seems to me like this shouldn't be controversial, as in, changing from one administration to the other, because we're not talking about compelling any of our employees to invest in this way. We're simply talking about making sure that they would have this as an option to do. As you think about this from the perspective of the folks, as you said, to put yourself in the head of those HR offices or those who are doing the managing, are there fiduciary concerns? Are there issues that people need to be thinking about in terms of?
Okay, I think you froze. So are there any fiduciary issues? I think that was the question.
Yes.
So I first of all, I think with all of the with the, I'll just say like the situation in a couple of years ago, that I think a lot of plan sponsors were concerned. They wanted to make sure that they were that they had again, kind of getting back to this idea that they don't want to break the law by accident. And I keep using these 2012 regs as an example, because I think a lot of people were confused, and like how you interpret these rules, and all of the lawsuits that came out for like excessive fees and things like that, and from very, very big institutions, prominent institutions. I think it's really important to understand that no one broke the law on purpose, right? No one set out to say, here's how we can do this. No, right? And no one gained from that, right? So I think the retirement plan, again, it's and I'm going to preface this with, I love retirement plans. Again, I'm a total nerd about this kind of stuff, but it tends to be off to the side. It tends to be that hidden money that no one talks about. I always say if a retirement plan is broken, you don't hear it because it doesn't cry, right? And so until there's something wrong, like really wrong, right? Until you get a letter from Ali, right? So we want to avoid that. And I think that there was a lot of concern around at a time when conversations around climate change were, mounting. And again, we're talking, especially when we're talking about universities, these are very smart people, right? Very learned people. And they, who want to be engaged. And so when something comes out that says you cannot consider these regulations, that I think sent a shock through HR offices all over, saying, okay, we want to make sure we don't break the law, right? And cost the institution lots of money. So I think that was really real and significant. But clearly that's changing. But I think the other things, and I don't want to say it's a risk, but I think it's a consideration when you really think about ESG. And I kind of level set with the definition that I gave. But also when you get down, like when you really get down into it, these factors, when you consider them, can help an investor, an advisor, identify potential risks and also identify potential return. But understanding how the different metrics, they're like these different, levers that you pull. So understanding that if you're going to take out traditional energy companies, oil companies, understanding that those are companies those are holdings that traditionally pay high dividends. So what does that do to the portfolio, right? For a fixed income, when you're doing a fund lineup, you have to have some fixed income on there. And so understanding how those things work, I think is important. Not that I expect, every person in HR who's responsible for this to all of a sudden, understand the links between these things. But I think that is a consideration. I think that whoever is responsible for the plan at the institution, if you don't have an advisor or consultant, and you don't have anyone on your investment committee, or if you don't have an investment committee, create one for the plan, right? And it could be some of the same people that are on the foundation, because they're exposed to a lot of investment information. And so again, I think it comes down to really kind of pulling your resources together, because you really have to understand, how, when you make this decision over here, how it affects the rest of the plan selection.
Oh, that's really helpful. Thank you. I wanted to take the opportunity to open it up now. And anyone who's listening in who has questions from the discussion, please put them in the chat, and we'd love to have the panelists answer. Just while we're waiting on that, I would love if you all would share any tips, suggestions you have as sort of practical next steps that colleges, universities can take. Ali, we'll all be waiting anxiously for you to release the rules, but once they're out.
Yeah, and I see that there's a question about undoing the rules as well, which is actually, I think, related to this. So I think, one thing that you can do now, one thing that you can do once the final rules are out, is just to engage in a conversation with your advisors about what they're taking into account and how they're taking it into account. I think the important thing that folks need to remember is that if you're coming at this and saying, I have to make sure that my retirement funds are more environmentally friendly, for example, you're not going about this the right way, right? Because the consistent message that we've put out over 40 years has been that your obligation is to the financial returns, right? It's the financial risk, financial returns. The message of the proposal and the changes in the market mean that no one should be saying that I have to choose between the values of my institution and the value for the retirement plan, because that is actually a false equivalency. And those things are not linked the way that for so many people they have thought that they were over the years. There's plenty of evidence that is not the case anymore. But going to the risk of undoing it, I mean, if you think about it, fundamentally what we're saying is let the market do what is appropriate, right? Let the market decide when something is financially material. Let the investors decide what is financially material. That message, I don't think, is inconsistent with with what the department has said in the past. And I view it as something that that is and should be viewed as very defensible in the event a future administration decides to take this on. Because we really shouldn't, it doesn't matter which party's in power. No one should be saying that you should keep risk on the table because we don't like that particular kind of risk. You know, I'm guessing that the folks on this call are thinking about ESG in one particular way. But for example, your values don't have to be you could be pro fossil fuel, for example, right? ESG is not by definition progressive. It can be pro guns, it can be pro weapons. Those are still things that fall under the rubric of ESG. So the kind of the association that ESG needs to kind of politically be one way, that also is, I think, part of what people need to understand. And I've made this observation before, but to the extent a future administration decides that they don't like what the Department of Labor ultimately does in this final rule and wants to undo it, I'm a political appointee and I will not be in that administration because it will not be this administration. So, you know, feel free to look me up and we can have a conversation about how best to engage with that iteration of the Department of Labor.
Ali, could you comment a little or just elaborate on what you just said about, you know, that fossil fuels could be in, that guns could be in. I get the point that Tiffany made around a process, but I think it'd be helpful just to for folks to understand what's in your thinking in terms of how those would fit within sort of the commonly used ESG frameworks now.
Sure. So I'm just going to posit this not as my personal beliefs or the department's beliefs, but just to illustrate this point. You could have an investor that says, you know what, I'm hearing a lot about the need to divest from fossil fuels. And as a short-term matter, I actually think the market is overestimating the transition away from fossil fuels. And those assets are underpriced right now. And so regardless of whether or not you believe in climate change, I don't think it's unreasonable for someone to say, you know, 2 months ago, do you actually use your example, right? If you'd invested heavily in oil, you would be looking back and saying like, oh, well, that wasn't a bad decision for me to make, right? That doesn't necessarily mean that that is the only prudent option because people often mistake whether something went up or went down as whether it was the right decision or not. It's actually, you know, the way Tiffany was talking about it is the way that you should be thinking about it. It's the process that you go through. Because none of us know what's going to go up or go down, and the people that are pointing out to you that there was money left on the table, they're no more right saying that than they would you would be right if oil had happened to go down. I mean, these are financial markets. They're not really alive, but they're kind of living, breathing things, right? They have a cadence that is not always 100% predictable, and that's why what our statute focuses on and what our rule in the proposal focuses on is the process that you're going through. That can mean different things to different people and in different contexts.
Great. Tiffany, Amy, you want to jump in on that? I think it's a really interesting point in terms of how we think about it.
Yeah, I mean, I think we still have, David, just two views, right? And you know what I think that in the final, you know, maybe suggestion here from my side is that this final rule, like this is going to be a great door opener to organize a conversation that's specific to your setting, to your campus around this topic. And I think that the trick is going to be asking questions that are not maybe so leading. And I think, you know, we've all committed, certainly TIA, I mean, this build out of the focus on ESG integration, you know, material issues across the platform. I think we are still going to have a certain part of our client base who do want to have options on the menu that avoid, I think, certain things that, favor specific social environmental outcomes. And we've been designing for that too, right? So I think we're going to have to figure out a way to coexist with the broader conversation around ESG integration. And, what we know for this particular market are going to be, more, I would say, more purity versus process. But I think we have to deal with process and purity, alongside each other.
No, makes good sense. Tiffany?
Yeah, and I'll just add, I mean, I think Ali's absolutely right. I mean, values are in the eye of the beholder. And I wouldn't say, values, beliefs, all of those things. If you're considering, these factors, who's to say? It might be, someone who wants to lean into, guns. That sounded horrible. But I mean, it really is. It's just there is no like one or two, or there's no set rule around this, But again, I mean, to Amy's point, like the institutions have to figure out, or have to, and every institution is different. So, what is the mission of your organization? And that's where it kind of, there's this continuum I like to think about, where it's ESG and the definition that I gave at the beginning of the discussion, and this, it kind of morphs into values-based investing, and on the other side, it's impact. And right now we're talking a lot about climate change, but there are other things that other causes that people believe in. I mean, we are really living in a time, at this intersection of climate change and all of these issues, and I think everyone, or a lot of people, are really coming to the realization that they have choices to make, right? In the people, in the advisors they select, in the products that they buy, and they're wanting that they're spending to reflect their values. And there are just some decisions that have to be made. But again, I always kind of circle it back, especially when it comes to the plan. That starts, again, if your HR team or whoever's overseeing the retirement plan aren't really experts in this, then you should hire someone who is. But then, you should also, that really starts with the RFP process. What questions are you asking in the RFP process that you're getting a consultant, an advisor that is appropriate for you? And also making the distinction between a retail consultant or advisor and an institutional one, and between an institutional one that focuses on foundations and endowments, and one that has a specialty with retirement plans, because they're two very different things. But through that process, ask all those questions. RFPs are like 100, 120 questions, right? There's enough real estate on that document to ask all the questions that you need. But it starts with an internal conversation.
That's really helpful. And I'm guessing that, Amy and Tiffany, you probably didn't get a lot of questions 2 months ago about, is Russia in my portfolio or not, when talking about the ESG lens, right? But now this is a dominant issue that's out there as folks are thinking about investment and what they purchase and other behavior, right? So this is an ever evolving terrain.
Yeah, it absolutely is. And then when you think about, again, I always think about things from a fund lineup perspective. When we're building a fund lineup, there are slots that we have to fill. Of course, index funds is one of them. So you don't typically have a lot of choice in that. So now there are all these products coming out where they're kind of, where you can kind of customize the index fund, and understanding. I think it was maybe Ali that said this in the beginning, or maybe it was Amy. Understanding what you own. If you have an index fund, you have a Russell 3000 fund, you might be invested in the prison industrial complex and not even realize it.
So one thing that we thought would be a helpful thing to do in the discussions with IEN and Second Nature, coming out of this panel and the rule changes that are coming, we actually put together for folks a draft pledge as we've been thinking about what steps can Second Nature and IEN take together with the members to try to accelerate our progress on climate, we thought that this Department of Labor rule change presents a real opportunity that's I think pretty low-hanging fruit for all of us. And so you'll see there, it's in the chat. And this is very much just something we put together this week. But we would love if everyone would take a look, send feedback to George and the team at IEN. But the idea here is to say, we, as part of what we're trying to do for climate action, are committed to making sure that as soon as the law makes it clear that this is coming, we are giving these kinds of investment options to our employees. And so that we will look at this, we don't say anything would be required in it, but just to sort of embark on this education and communication effort. So would love your feedback on that. If folks have had a chance to scan it quickly, if you have any questions, thoughts on it, we've got just a couple minutes remaining, but would love that. And while we wait to see if any reaction there, I just wanted to end up by just asking each of our panelists any final thoughts, reflections you have from the conversation. Maybe Amy, we'll start with you this time.
Thanks, David. I mean, it's been a real privilege to be part of this panel, and I think maybe the pledge will get us here, but we all just need to commit to furthering the conversation. We need to commit to education, starting in-house, and then there are some fairly simple steps here. I mean, the RFP question, adding to RFP. I think we've certainly worked with a lot of plan sponsors on these broader educational sessions. We'd be happy to partner on that. Certainly, once Ali tells us what's in the final rule. But I think that we really have an unprecedented opportunity here to re-engage on campus and get this conversation accelerated.
Absolutely. Tiffany, how about you?
I think that we've said a lot here, and again, I just go back to, I think there's so many resources, available, including all of us on this panel, but the Intentional Endowment Network as well, and it's like seek out that information, and I sometimes I find that when I'm speaking to a plan sponsor, they might not want to express what they don't know, and so I would just leave everybody with the message that this is not something that most people know. Like, unless you do this every single day, I wouldn't expect anybody to know anything about this. So ask all of the questions. If you're whoever you're working with, even a record keeper, ask them those questions. Most record keepers have, a personnel that are there to answer whatever questions that you have, and don't get off the phone or the Zoom until you understand what their responses are.
Great. Ali, how about from you?
Yeah, I would actually really echo what Tiffany said. Speaking as a regulator, people don't get in trouble because they don't understand something and ask questions. What we do see time and time again is that they don't understand it. And frequently it is kind of that human nature. I'm going to be embarrassed in front of my peers if I ask what's the dumb question, because everyone should know what they're talking about. I mean, there are going to be people that are selling you bad products, right? And part of the obligation is to ask those questions. So I would absolutely, double down on that. But I think more broadly, I know everyone's eagerly awaiting the final rule, but even now, I don't think it's too early to start having those conversations, right? Asking those questions, understanding where you are now, and thinking about where you want to get to, and kind of putting that process in place for ultimately what will be a final rule, hopefully in the not too distant future.
Well, I think that's great advice to end on. I think my immediate takeaway is, we have a faculty and student advisory board for the investment of our endowment. And I think my goal is going to be to give them the link for this session, have them listen, and then have a conversation about how we can influence this as well. And Amy, I think what you shared in terms of, the ability to look at how you voted on all of these and their ability to use the voice mechanism as well, I think could be really powerful. So thank you all so much for taking this time. It's been really informative. And Ali, we wish you all the best with the spring of rule writing, and look forward to the outcomes from it.
Thank you.
Thanks, guys.
Thank you, everybody.
Yes, thank you, everybody. And
Great
I just want to add my final thanks to you, David, and to all the panelists for taking the time to share your expertise on this. It's such an interesting topic, and I know it can be a very complex one. And I know I've got a lot of faculty and sustainability directors in the audience. So I just want to encourage you to know that, we can take these conversations to your HR folks, to your presidents, have them consider this pledge, which can initiate a process, as David said. Chris Walker, who's leading this initiative for us at IEN, has been active in the chat and can help. We've got a guide that can help institutions move this forward. So we know how busy everyone is and how complex their retirement plans can be, and it's something that people don't necessarily think about every day, but we want to help sort of take some of that off your plate, but still move it forward at your institution. So please do be in touch. I'm looking forward to seeing what we can do across the sector with this. So thank you again, Ali, for all the work you're doing at the Department of Labor, for taking the time today. Amy, today, thanks so much for your insights. Thanks to all of you for sticking around into the evening today. And we look forward to seeing you back tomorrow afternoon for another great round of sessions. Thanks, everybody.
Thanks. Have a good evening.
Bye. Thanks, guys.